I'm going to talk for a bit at the start, just give things a bit of context before handing over to John, who's going to go through the actual investment strategy statement. Um, there is, we have planned for some time at the end to ask questions, but if you do as a question as we go through, we will try and answer those. I can't see them on my screen at the moment because I'm sharing, but David will flag up for me if there's any questions that it might be worth me answering. And we will make sure there is some time at the end. So thank you very much for joining us. Okay. So the investment strategy statement is not a new thing. It's been slightly rebadged, as I'll go on to explain later on. At West Yorkshire Pension Fund, we've always done the investment strategy statement, done the review in between actuarial valuations. So you would typically finish your actuarial valuation process, which you need to do every 3 years, and then use the results and the data that you got from that actuarial valuation to do your investment strategy review. That's probably fairly typical across the local government pension fund, local government pension scheme. But government is looking to sort of formalise this in regulations, the timing of doing these investment strategy statement reviews. Most of you will be aware that we had a valuation at 31st of March 2025. You get a year to complete these valuations, so we completed that by March this year. The new contribution rates took effect from 1st of April this year, will apply for 3 years. I don't know why I've put 2006 rather than 2026 on that next line. And then we have until 30th of December 2026 to finalise the ISS according to these new regulations that are just about to come in. You get 6 months from the regulations coming into effect, which is going to come in at 30th of June to complete this process. It's a little bit more complex than that, the timing, because one of the things that's changing is government is looking for asset pools, and John's going to go on to explain a little bit more about asset pooling to provide strategic investment advice to their LGPS partner funds. Previously, each LGPS fund has gone out and sought their own advice or taken advice from their own internal team. Government is looking to move towards pools providing the advice to funds, but most pools aren't yet set up to provide this advice. So government have introduced a sort of window where you could get advice, complete your investment strategy review using the old method, external advisors, internal teams, etc. But that window closes on 30th of December 2026. So that's the relevance of that deadline. And then it won't be all that long until we start the planning for next time for the 31st of March 2028 valuation, and this sort of triennial cycle will go on from that point. Important context are the results of the 2025 valuation. I'll go on to explain why. We had a good outcome. The last few valuations, we've generally seen a positive trend, both at West Yorkshire Pension Fund and across the LGPS in general. So we did have a surplus when we measure things at a whole scheme level. Our assets at 31st of March 2025 were a fraction under 20 billion. And the estimated value of the liabilities, the obligation to pay pensions to members, the actuary was estimating about 17.7 billion. So that's a surplus of slightly over £2 billion, at a funding level of roughly 113%. It's very much an estimate, the liabilities. It all depends what assumptions you use, which I'm going to come on to explain on my next slide. But the assumptions that our panel chose based on the actuarial advice put that figure on the liabilities. The assets are what they are to a certain extent, although there is some private market assets that you need to estimate the value of. But that's broadly a statement of fact. The assets, the liabilities is subjective. And that meant the contribution rates came down. I'm not sure if it's quite all employers, but certainly the vast majority of employers in West Yorkshire Pension Fund did experience a reduction in contribution rates from April this year. There's two parts to the contribution rate. So one part is called the primary rate. This is broadly the cost of building up another year's benefits in the scheme. Administration costs are also included there. And that is similar. It won't be exactly the same for all employers because membership profiles will differ slightly. Sometimes can be slightly cheaper to provide pensions to younger members than older members. And member earnings has a difference as well because that affects the employee contribution rate, but it's broadly similar for most employers, the primary rate. Then the second part of the contribution rate is what's known as the secondary rate. So this is where we adjust up or down the primary rate to reflect whether there is a surplus or a deficit. Most, if not all, employers now have a negative secondary rate, so we reduce that primary rate to reflect that they've got a surplus. And we effectively have a section of the fund for all employers. So we've roughly got 400 employers participating in West Yorkshire Pension Fund. So they all have a notional share of those assets and the liabilities. But we do group certain employers together, mainly for administrative simplicity, where they've got similar characteristics. We tend to group together, which makes things easier to administer, both from the employer's perspective and I think from West Yorkshire Pension Fund's perspective. So I mentioned before that the liabilities are very much an estimate. At 31st of March 2025, the main assumptions used to put that £17.7 billion figure on the liabilities were the three in the table here. So you've got a discount rate. This is broadly equates to the future investment return we're looking to achieve. You need to be prudent, so you need to use a number that you're confident of outperforming. But where we know we have an obligation to pay a member a pension many years into the future, we don't need all of that money now. We just need a proportion of that money because we expect to generate a positive investment return between the current date and the point in time in the future where we need to pay the benefit. So for some relatively recent retirees, maybe a member that's retired at 60, it's quite conceivable we could be paying a pension for another 30 or 40 years. So we need to put money away now in order to pay that benefit in future. And even for a young active member in their early 20s, we are putting a value in this valuation on the payment we'll have to make to them in 70, 80, 90 years' time. It'll be a very small amount, given all the sort of compounding over the years and life expectancy, etc. But every single benefit that's promised goes into that £17.7 billion figure. The vast majority of benefits in the local government pension scheme are linked to inflation, and it's CPI measure of inflation that is used. So the important thing, I wouldn't look at these two assumptions necessarily in isolation. The key point to note is that we're looking to get at least 2.4% above inflation. So inflation, the actuary assumed 2.1%. And this is a long-term estimate, a sort of 20-year roughly projection into the future, and then assumed a discount rate or investment return of 4.5%. So it's that gap between the two that's the important thing here. Didn't always used to be the case, but interest rates where they are at the moment, we can broadly lend to the UK government at 4.5%, which you think great. But the difficulty is if inflation is higher than we're expecting, we'd actually need more than 4.5%. So if the benefits all increase by more than 2.1, we would need more than 4.5% to make sure that the numbers work out. So all the figures you saw on the previous slide, that 17.7 billion value of the liabilities, the 15.7% primary contribution rate, they all assume that these assumptions on this slide hold. So they could get better or worse, those figures, depending on how we do against these assumptions in future. So that's the sort of context that we're doing this investment strategy review against. One of the important factor is liquidity and cash flow. So this slide sets out, this is information taken from our West Yorkshire Pension Fund accounts, sets out the sort of key cash flow items. So the top line is the contributions coming in, so that's the employee contributions and the employer contributions. The next two lines are money going out, so benefit payments to members, mainly pensions, but retirement lump sums and some other benefits, plus expenses of running the fund. And then the fourth line is these two numbers added together. So you'll notice that the amount going out in benefit payments has for the last few years exceeded contributions in, and it's been getting bigger. And it's going to get quite significantly bigger again in the 26-27 year. So I mentioned that employer contribution rates generally fell with effect from 1st of April 2026. You'll notice that 667 million figure we had for the year to 2026 will be quite a lot lower for the year to 2027. It'll probably be low 500 millions, I would have thought. It obviously depends on exact membership numbers. And benefits tend to increase every year. There's two things going on. There's an inflationary increase which gets applied every April to pensions in payment. But we also tend to have more retirees than we have pensions ceasing. So typically, if inflation is at a sort of normal sort of level, we might see the benefits payable go up by about 7% in a year. So that 227 million negative cash flow, that will be quite a lot higher in the year to 2027. It could be 350 or 400 million. This isn't really a problem, or hasn't been a problem, because we do get investment income in addition to the contributions we receive. It's tended to be around the high 500 millions in recent years. Certain stock markets are better than others for paying an income. The UK stock market, whilst it may have underperformed some other markets in other parts of the world, does pay quite a reliable income stream. American stock market has tended to pay less in the way of income. But we do get income from other sources, properties, private equity funds that we're in, etc. But some of our private market assets, which John will go on to explain, it can be quite difficult to predict how much and when the income we receive is. So there is an uncertainty there. Even if the investment income did fall below the sort of net additions figure, it's not necessarily a problem. We would just need to sell some of our assets. But we do need to bear in mind that you need things to be liquid, or you need a certain proportion of the portfolio to be liquid, and you don't want to be a forced seller. So if you do need to sell assets to pay pensions, there is always a risk that you're selling in an inopportune time. So having sort of investment income covering cash flow is always a positive. So hopefully that gives a bit of clarity on the importance of liquidity. We did have a good year to 2026 in terms of investment performance. John will go on to explain how global markets did, but we had a decent year, and I think we'll have a better year than most LGPS funds, although I haven't seen other funds figures as yet. There tends to be few in the public domain. I'll quickly, before I pass over to John, mention a bit more about the regulation changes that I talked about earlier. I think it might have been the 21st of May, the government laid new LGPS investment regulations, which come into force on the 30th of June. I mentioned the timings around doing the investment strategy review. There's other implications of these new regulations. Government, John will go on to talk about pooling, but government's been very clear about the model of investment pooling they're looking for in the LGPS, and we've needed to make changes as a result. And there's also a requirement to at least consider making local investments, something that we were certainly considering anyway, but is a formal requirement in these regulations, and it's something we're looking for employer views on as part of this strategy review. And a very, very important point, the sort of second from last bullet, the remit of the West Yorkshire Pension Fund Advisory Panel and all LGPS pension committees is changing. So it used to be that it had sort of total control over investments, but government is looking to pass the implementation of strategies, the actual making of investments, whether it's buying or selling individual stocks or appointing external fund managers. It's looking for the pools to do that. And it's a higher level role from an investment perspective they're looking for from pension committees, such as our advisory panel, just setting the strategic asset allocation. So the allocation to high level asset classes like equities, bonds, property, etc. They want all the detail to be done at the pool. So that change has been introduced by these investment regulations. Okay, David, is there any questions on chat, or would any of the attendees like to ask any questions at this point?
We have one question on chat from Sam Stevens. It's could you please explain pay growth on I think it's slide 5?
Of course, I did move quickly over that. It's become less relevant. So prior to 2014, the LGPS was a final salary scheme. So pay growth was quite an important assumption because for active members, you would need to project forward what their pay was likely to be at the point they reached retirement, because their pension, when they got it, would be linked to their final salary. So you used to get, between 2008 and 2014, the benefits were 1/60th of final salary for each year of service. They changed in 2014 to being what's known as a career average scheme. So the accrual rate improved. You get 1/49th rather than 1/60th now. But that link to final salary has been broken. So what we do is we revalue the pension you earn each year in line with inflation up until you reach retirement. But for members who were in service at 2014, all the benefits they earned prior to 2014 have still got that salary link. So I actually joined on the 3rd of March 2014. I've got 28 days of the old final salary benefits. So that part of my benefit is still linked to my final salary at retirement, or if I leave at an earlier date. But it's becoming a lot less material, that pay growth assumption. It just affects that accrued service up until 2014. New members, it's not really relevant. But I just kept that in there as an assumption, which still does have some bearing on the results. So that's relatively minor these days. There is a sort of salary scale in the background as well. That 3.35% is a kind of inflationary pay award expectation. It varies between employers, but that's what that assumption is. So I hope that helps there. Okay, I shall pass over to John, if that's okay with people.
Thanks very much, Ewan, and good afternoon, everyone. I'm going to take us through some of the details of the investment strategy statement that's currently being consulted on, and some of the changes and the rationale for those. In terms of what this document is for and what it shows, there's a number of things here. It's very much a guiding document for our long-term investment framework. So it covers everything from how we make decisions, what principles are used, how responsibilities are allocated. So it really sets the framework within which the investment team operates. So it's linked to the investment strategy, and we'll go on to talk about the investment strategy review, which is a 3-yearly piece of activity that follows the actuarial valuation. It establishes the governance, so who does what, and make sure that the decision making is well informed and transparent. It is the mechanism by which our advisory panel can dictate the terms on which they want the fund's assets to be managed. So long-term beliefs, the kind of diversification and the balance between risk and return, as well as liquidity that Ewan referred to. So as part of that, there's what we call the strategic asset allocation. That gives a broad delineation of the different asset classes and the target amounts to be held within each of them. It's not a really strict statement. It's a guideline around which we can operate, because assets will move relative to the targets and the ranges with normal market movements, but it gives some broad guidelines within which we can operate and exercise investment discretion. Part of the document also covers responsible investment, the important elements that the panel have determined we should reflect in our investment activity, and then it touches on the risks and how this strategy will be monitored. There's broadly two things happening in terms of the changes to this document. One is the regulatory change that Ewan described, and this has been a long time coming. We've been working in partnership with 2 other North of England pension funds, Greater Manchester Pension Fund and Merseyside Pension Fund for 10 years and even longer. But the government's direction and its legislation is to formalise that with a formal commingling of the assets of the three funds that will be under the responsibility of what we call Northern LGPS. So this is a new FCA regulated investment company that will shortly be established to manage the assets of the three funds. The Financial Conduct Authority, or FCA authorization piece, is relevant because while you're only managing your own assets in broad terms, as we have been within West Yorkshire Pension Fund, it's not necessary to have that formal FCA authorization. When you are running an investment company operating on behalf of other asset owners, in this case the three pension funds, then it's important to have that authorization, and with that the processes, safeguards, reporting that are expected under that regulatory framework. The three pension funds, West Yorkshire, Greater Manchester and Merseyside, will be both the clients and the shareholders of this company. So it's not a dramatic change in terms of the process. There is a transfer of a significant number of the staff, the investment staff in the three pension funds into that entity that we anticipate to happen in the coming months. I have been, since April last year, Chief Investment Officer of West Yorkshire Pension Fund, and have recently been appointed as Chief Investment Officer of Northern LGPS, of that wider investment company. So there's continuity in that respect for West Yorkshire in terms of management and oversight of the fund's assets. In terms of the division of responsibilities, the funds will continue to take the ownership of establishing the strategic asset allocation, that broad split by asset class, which dictates the trade-off between risk and return, and other key elements, for example, the responsible investment policy, and will continue to exercise oversight of the investment management process through the same governance frameworks and advisory panel. Northern LGPS, on the other hand, formally takes responsibility for the implementation, the management of assets within that new investment vehicle. So I said two different parts. One part is the regulatory change, and as part of that, there were certain things that were specified as needing to be in place, how the strategic asset allocation is codified within the investment strategy statement, how we frame our local investment mandate is something that the government is quite keen to see being made explicit. So we've brought those out in this new revised document. And some of the other changes are more what we would consider business as usual, that would follow the triennial investment strategy review. So if we can go on to the next slide, thank you. What the investment strategy review does is to, in the same way that the actuarial valuation takes a snapshot of assets and liabilities, considers the current membership of the fund, considers how the assets and liabilities may evolve in future. The investment strategy review thinks about specifically how the strategic asset allocation reflects that updated membership, that updated funding level, and also the prevailing market conditions, which, as we'll see in a moment, have changed quite dramatically from where we were in March 2022, when the last actuarial valuation was conducted. And this is a really important process of reviewing the different ways that the fund's assets could be allocated, which risks you're taking. Are you happy with the overall level of investment risk? Because whenever you're seeking to generate long-term investment returns, there's a trade-off between how high the return is that you're targeting and how much risk that you are taking in order to achieve that that level of expected return. So what are the trade-offs being made there, and are we comfortable with them? Both at an overall level, we normally look at metrics like in a bad scenario, let's say in a 1 in 20 year scenario, what are the things that could happen? And while it's not possible to predict the future, you can look at potential scenarios and the different trade-offs you make. Different asset allocations entail different risk levels. So this is quite an extensive piece of analytical work with modeling provided by our third-party investment advisors and a number of steps. We have worked on it internally within the fund, with Ewan, with the investment team. We then have discussed it with our third-party advisors and presented our conclusions to our advisory panel before those recommendations being embedded in the investment strategy statement and being consulted on. So as well as the overall risk and return, we think about specific scenarios for some of the metrics that will drive the behavior of both the assets and liabilities. So we think about things like extreme recession scenarios, how inflation may impact both assets and liabilities, not just the cash flows that we have from our assets today, but if we found ourselves in an extreme scenario, would we have enough cash flows to meet our short-term pension payment needs in any reasonable scenario? And similarly, liquidity. Some assets that we invest in would be difficult to sell in certain scenarios, may take longer to sell, and if we were forced to try and sell them at short notice, could result in a loss of value in those assets. So you may only be able to sell them at a price lower than you think is fair. And we did some rigorous testing of those different scenarios to make sure that we were happy with the overall blend of liquidity and cash flow provision within the assets. I talked about local investment. We have for some time had a desire to support local economies, local people, and have expressed that through the Sustainable Development Goals, the UN Sustainable Development Goals that our panel have reflected as the priority for the fund. What the regulatory change has brought about is a need to be a bit more explicit in that. So that's something that we have put in the document, and I'll come on to. A brief word on how the assets have performed. Equities still compose the majority of our strategic asset allocation. Currently 60% of the fund's assets in terms of their allocation in the SAA, the strategic asset allocation. And what we've seen, particularly over the last year, 18 months, is extremely strong equity market returns across all the regions in which the fund invests. The way in which we manage the portfolio is to split the global universe of listed equities into 6 regions that you see here. So UK, North America, Europe, Asia Pacific, Japan, and emerging markets. And we allocate specific weights to each of those regions. And what you can see from the chart here is over the first sort of half of the last 5 years, you saw fairly stable, but generally slightly sort of flat returns from equity markets. But over the second half, particularly from 2024 onwards, we've seen very strong above trend performance from most of the regions, and there's been significant dispersion between regions depending on the types of stocks and industries that make up their equity indices, but overall higher than you would typically expect over the long term. The highest one here is is North American market. These are the kind of returns for a sterling investor as the fund is, but all of these returns reflect strong above trend equity market returns, particularly over the last year, 18 months. And turning the page, the government bond market has perhaps had an even more marked change that Ewan alluded to. If you look around the March 2022 point of these charts, then you can see a big increase in both the what we call the nominal gilt rate or conventional gilt rate and the real gilt rate. I'll just explain what I'm showing here in the charts. These are the long-term expected returns that you achieve by lending to the UK government over 30 years. I picked 30 years because it's a long period, broadly aligned with the average term of the liabilities of the fund. So you can see, going way back to March 2022, you were getting less than 2% per annum of return by lending to the UK government over 30 years. Fast forward to today, and that rate is closer to 5.5%. So bonds are significantly more attractive than they were at that time. The right-hand chart shows what we call the real gilt rate. So this is specifically lending to the UK government and receiving in return an inflation-linked payment. So this is very valuable for a fund like ours, because you can protect against the risk of higher inflation that would impact the liabilities by investing in an asset that will give you a return linked to that inflation. So going back again to March 2022, you had to pay essentially to get that protection. You'd get a return of 2% below what inflation was expected to be. And today, in broad terms, you're getting a return of 2% above what the market expects that inflation to be. So that's a much more attractive environment to be holding that kind of asset when we're looking to pay long-term inflation-linked payments. The other things to think about are diversification. We still have a relatively concentrated allocation to developed equities in the portfolio. And also the funding position, which, as Ewan described, has improved somewhat from the 2022 valuation. So what this means is that, all else equal, it's perhaps prudent to take a little bit less investment risk and lower the allocation to equities, which we expect to deliver higher long-term returns, and diversify the portfolio a little bit more. And these slightly detailed tables here show what we proposed in the document, the outcome of the exercise that I described. What we have here is the same thing represented in two formats. The left-hand format is the one we've historically used, which is a little bit more granular, and it specifies the split between all the different regions I described, and is slightly more granular in how the asset classes are represented. The government, for the purposes of simplicity, has asked for the format to be shown as it is on the right-hand side to simplify and to allow the pool's discretion on how they best implement that strategic asset allocation. So what you're looking at here is the same thing in slightly different ways. What has changed is the numbers we show in the SAA benchmark to reflect those factors I described. Slightly less in equities, slightly more in bonds, both conventional, so fixed payment bonds, and inflation-linked bonds. And with that objective of diversification, investing a little bit more in infrastructure and what we call alternatives, which is a sort of broad idiosyncratic set of asset classes that gives us different exposure to elsewhere in the portfolio. So slightly lower allocations to equities, more in bonds, more in infrastructure, more in alternatives. We've also proposed slightly wider control ranges to give some flexibility. We do think that markets are somewhat extreme in their current pricing. We've seen good performance in equities, but we're conscious that this kind of long period of performance of this type may be followed by potential periods that have lower returns. So some flexibility within those ranges is welcome. Just to make that explicit, on the next slide, I've shown the before and after of the allocations. This isn't a dramatic change. We still think, as a long-term investor, equities have an important role in the portfolio, but we've reduced that allocation from 60% to 55%, reducing the risk with increases of 2.5% in the bonds and plus 1.25% in the infrastructure and the alternatives. On the next slide, I mentioned local investment, and this is just one excerpt of how we've represented that. We've been clear about what we mean for local investment, and the fact that we are pooling our assets with the other two pension funds means that it makes sense for us to look collectively across the whole northern LGPS region. So to establish a policy where we work together to invest across all the regions of the combined authorities, Greater Manchester, Merseyside and West Yorkshire, to try and bring our collective resources and generate the most impact to local initiatives. And we've suggested an allocation of up to 2% of the fund's assets. This could go higher if we find the right investment opportunities, and based on the fund's assets as of today, that represents around 500 million of assets overall that we would look to deploy in this way, subject to getting the right trade-off between expected return and the risk inherent in those assets, akin to the way we look at any investment in the fund's portfolio. In terms of the types of local investment, here are two that we have already undertaken in local housing, both based in Leeds. One is an equity commitment, one is debt lending to help the development of residential property of homes in the region. But there are quite a broad range of types of local investment we would look at. Another one is supporting fast-growing technology and healthcare type businesses that are incubated in some of the most pioneering universities in the region. There's a venture capital initiative that we invest in called Northern Gritstone that does that. We might also look at local infrastructure, lending to small and medium-sized businesses, natural capital in the region. So there's no limit to the sort of type of investment opportunity we would seek for the fund, but it needs to meet those risk and return hurdles, as well as achieving the benefits we would look for in terms of local economic stimulus, jobs, growth, or other metric we have. So that's all I had. Handing back to you, Ewan, for the next piece.
Okay, thank you. Do we have any questions for John, David?
Nope, no questions, unless anybody would like to put their hand up.
Okay, well, do interrupt me if any questions do come in. I was just going to summarise before we close the next steps. So we It is a formal consultation with employers. The consultation on the investment strategy statement is open formally until 2nd of July. If you do want to submit a response, there is a link there, and you should be able to find it on both the front page of the West Yorkshire website and in the employers section as well. If you need slightly longer, please feel free to message myself or John separately. We can't guarantee to consider any responses received after 2nd of July, but we're always happy to hear from employers and hear their views on things. So if you can't make the 2nd of July deadline, please still feel free to send your comments. We're going to take all the responses received to the West Yorkshire Pension Fund Advisory Panel at its next meeting, likely to be around the end of July, hence the 2nd of July deadline. And then the panel will consider the responses received and whether to make further changes to the investment strategy statement before finalising. Once finalised, we will put the investment strategy statement on the West Yorkshire Pension Fund website, and then it will be up to John and his team to implement the changes. There's no real fixed deadline for implementing the changes. John mentioned that there are ranges on the asset classes, which does allow us to be a little bit selective around timing. We won't be forced to make wholesale changes to the portfolio overnight. We'll do things at a sensible pace to preserve value. But over a period of time, we will implement all the changes that are consulted on and agreed by the advisory panel. So I think that brings us to a close in terms of what we wanted to talk to you about. If there are any final questions in relation to any of the things we've discussed, please do feel to put something in the chat or put your hand up, or feel free to submit something to us after the event. Is there anything at this stage, David?
No, we've received nothing at the moment.
Right. Okay. Well, I'd like to thank you for attending and thank you for listening. And for those who are looking to provide a response to the investment strategy statement consultation, thank you for that. So I wish you all good afternoon. Thank you.